Welcome to the third and final section of PowerPoints for the accounting workshop. In this section, we will look more closely at the income statement and the statement of cash flows. For our purposes, an accounting period will be 1 year. Income generating activity occurs continuously in modern firms. Financial reports are prepared at the end of time periods of uniform length, for example, months, quarters, or years. Uniform time periods facilitate comparisons and analysis. If you remember from section 1, you were able to review by going to the Investor Relations website the annual reports, which included the financial statements for Walmart, Kmart, and Target. Many companies use the end of the calendar year as the end of their accounting period. So, if a company's accounting year ran from January 1 to December 31, they would be on what's called a calendar year end basis, December 31. There are many exceptions to this rule. For example, retail stores that want to include the entire Christmas season in one accounting period would not want to end their accounting year on December 31st due to the Christmas season. They could pick any other 12-month period for their accounting year. Their accounting year would then be called a fiscal year, so they could run from July 1 to June 30th and have a fiscal year end on June 30th. Their cash basis of accounting is not permitted under generally accepted accounting principles. As we briefly said in section 2, revenues are recognized when a good or service is delivered, not necessarily when the cash is received. So if we recognize revenue when the cash was received, that would be called the cash basis of accounting, but it's not allowed under generally accepted accounting principles. The accrual basis of accounting recognizes revenues when we deliver a good or service, and it matches the expenses to revenues irregardless of when the cash is received or paid. Hopefully you were paying attention during section 2. You don't necessarily receive cash to have a revenue, and don't necessarily pay cash to have an expense. Revenues are amounts earned through delivery of goods or services. When you make a sale on account, you have a revenue, but you have a receivable. You could also have a revenue resulting from a broader transaction as long as you delivered a good or service. When you pay for something with cash, you do not necessarily have an expense. For example, if you bought inventory, you have an expense when you use something up in the process of earning revenue. So, for example, we looked at cost of goods sold. When we sold the inventory, then we had an expense called cost of goods sold. Matching or recording expenses is a little bit more difficult because the way we incur an expense differs by the type of expense. If you recall, we looked at rent. Rent becomes an expense during the period of time that we use the facility in the process of earning revenue. Some expenses become expenses through consumption. For example, supplies. We have an expense for supplies when we use them up. Revenues and expenses are recognized independent of the timing of the cash flow. So again, when we receive payment, we do not necessarily have revenue. For example, this is a little bit tougher concept, but if we are paid for a good or service in advance, we actually have a liability. We owe the good or service that we've been paid for. We do not have a revenue. That's called an unearned revenue. It provides information on long-term profitability, and it's subject to manipulation by the choice of recognition rules. When does the accountant recognize the revenue? Both the following must be met. The first one, the firm has performed all or most of the services where it has delivered the goods, that is, it has earned the revenue, and the firm has received a good, service, or right in exchange and can reasonably measure the value of the goods, service, or right. A promise to pay, such as a receivable, is a right. Revenues are measured by the cash equivalent that the company expects to receive. Uncollectible accounts have no value by definition and are not included in revenue. And sales, discounts, and allowances are reductions in the price and not included in revenue. A sales discount is a discount given for prompt payment, and an allowance is normally given for delivery of substandard goods. Sales returns are a reversal of the sale and are not included in revenue. I think you know what a sales return is. Delayed payments may carry an implied interest charge. This implied interest would not be included in sales revenue, but rather would be included as interest revenue. Assets provide future benefits to the firm and are consumed in the process of generating revenues. As assets are consumed, the value of the remaining asset is reduced and an expense is incurred. Thus, assets flow out of the firm as expenses. We've already looked at cost of goods sold and the reduction of inventory. Remember, cost of goods sold is a debit because it's an expense, the only expense that does not end with the word expense, and we credit reducing inventory an asset when we sell the inventory. So here we have an example. Assets on the balance sheet are unexpired costs. When they're used up, they become expenses, reducing income on the income statement as expired costs. The expense reduces shareholders' equity on the balance sheet. I hope you remember how to do this. The reduction in shareholders' equity is a result of an expense which is a debit, which results in a reduction in retained earnings, a component of shareholders' equity on the company's balance sheet. Accountants recognize expenses as follows. Number one, an asset expiration associates directly with the revenue. That expiration recognizes expense in a period when the revenue is recognized. That is, the expense is matched to the revenues. Two, if the asset expiration does not clearly associate with revenues, that expiration becomes an expense in the period which the firm consumes the benefits of that asset. So going back to example 1, that's the sale of the inventory, the debit the cost of goods sold, and the credit to inventory. In example 2, we've already mentioned rent, but another asset that could expire in a similar way is insurance. Insurance becomes an expense through passage of time. Product costs are the cost of making a product that is not an expense until the product is sold, and then it becomes a cost of goods sold expense. Prior to the time, the cost is an unexpired asset or inventory. You'll actually explore product costs much more in MBA 660 Managerial Accounting. Marketing costs may or may not give rise to revenue. Most accountants prefer to expense marketing costs when they are incurred. A period cost is a cost expensed in the period incurred. Administrative costs cannot easily be matched with revenue, so they are considered a period cost. In fact, both marketing and administrative costs are expensed in the period they're incurred and are period cost. Product costs are expensed when the product is sold. The balance sheet reports assets and the financing of those assets at a point in time. We looked at the balance sheet in section 1. The income statement reports revenues, expenses over a period of time. So if you remember from section 2, we closed the income statement accounts revenue and expenses to zero at the end of the period because they're only looking at a period of time, and then we start over. Dividends are returned to shareholders and are not an expense. This is important. Dividends or withdrawals are not an expense. They occur after the determination of net income. To two consecutive balance sheets are connected by the income statement. The income statement is done first. The income statement accounts are closed to retained earnings on the balance sheet. Beginning retained earnings plus the net income minus the dividends or withdrawals result in the ending retained earnings reported on the company's current balance sheet. Again, and this should be a review, assets equal liabilities plus shareholders' equity. Assets equal liabilities plus the two components of shareholders' equity. One component is the investment by owners into the company contributed capital and the retained earnings, the accumulation of net income minus dividends since the inception of the company. Here's a further example of that. If you look at the very bottom, retained earnings at the beginning of the period plus net income for the period minus dividends paid during the period equals the ending retained earnings for the period. Here's a further expansion. Retained earnings. Retained earnings is the beginning retained earnings plus revenues of the periods minus the expenses of the period. Remember, revenues minus expenses equal net income. Minus the dividends for the period, the withdrawals by the owners equal the ending retained earnings for the period. Revenues, expenses, and dividends are all closed to retained earnings. Recall that retained earnings normally carries a credit balance since it represents a source of financing. Thus, credits increase retained earnings while debits decrease retained earnings. Shareholders' equity and retained earnings is increased on the right by revenues. It's reduced on the left, debits, by expenses. Revenues minus expenses equal net income. It's increased by contributed capital, issuance of stock on the right at credit, and it's reduced on the left by dividends. Dividends are withdrawals from the company and paid to the owners. Think about what retained earnings means. Retained earnings. Earnings and income mean exactly the same thing. So the accumulation of income or earnings minus withdrawals or dividends is the earnings that's retained by the company. Some journal entries are made at the end of the accounting period just to separate the effect of an event into proper periods. Examples include recognition of accrued revenues and receivables and the calculation of interest. Remember, interest is earned during the period, not when it's received, so it's earned during the period of time that it's earned. Recognition of accrued expenses and payables. Let me just explain this a bit. Accrued means that the cash portion of the transaction hasn't taken place. So these are expenses and payables that have not been paid with cash. The next one, number 4, allocation of prepaid operating costs. These are allocating the cost of assets used up during the period because they've been used up. And also recognition of depreciation at the end of the period. Remember, depreciation is the process of allocating the cost of a long-lived asset. So now is an expansion of the accounting process. We analyze the transaction. We journalize. Journalize is the point of original entry, the first time the accounting information enters the accounting system. We post to individual ledger accounts. We use T accounts. We make adjustments in correcting entries, and we then prepare the income statement. We make the closing entries, and then we can prepare the balance sheet. The balance sheet is assets equal liabilities plus stockholders' equity. Stockholders' equity is made up of paid-in capital, the investment by owners, and the retained earnings in the company. Now we're going to briefly look at the statement of cash flows. The statement of cash flows explains the reasons for a change in cash, classifies the reasons for change as operating, investing, or financing activities, and reconciles net income with cash flow from operations. Operations, the operating section of the statement of cash flows, are cash flows related to selling goods and services, that is, the principal business of the firm. There are two methods for doing this statement of cash flows. There is the indirect method and the direct method. Although the Financial Accounting Standards Board recommended that companies file their statement of cash flows through the direct method, almost every company files their statement of cash flows using the indirect method. The indirect method starts out with accrual basis of cash, or the accrual basis net income, and then adjusts it to the cash basis. The way we do that is we start out with net income. We add back depreciation because depreciation was a non-cash expense on the income statement. We add back losses, and we subtract out gains. In the operating section, we include changes to current assets and current liabilities. I will be providing a handout on the statement of cash flows. Current assets and current liability changes reported in the operating section are recorded as thus. An increase in an asset results in a decrease in cash. A decrease in an asset results in an increase in cash. A quick example of why that's true is think about a receivable. If we make a sale, if the receivable increased, that means we actually got less cash. If we decrease a receivable, it means we actually got more cash. Let's look at the liabilities. An increase in liabilities is an increase in cash. Let's say we have an expense and a payable. If the liability payable increased, it means we didn't pay for that expense in cash. So an increase in a liability increases cash. And then rule 4 would be a decrease in a liability would be a decrease in cash. Why? Because we paid it. The investing section is cash flows related to the acquisition and sale of non-current assets. The investing section includes sales of property, plant, and equipment and other non-current assets. Financing section are long and short-term cash flows related to liabilities and owner's equity. Dividends are a financing cash outflow. These are changes in long-term liabilities and all changes to stockholders' equity, including the payment of a dividend. Firms could prepare the cash flow directly from the cash account. Most, however, find it more efficient to prepare the cash flow statement from the balance sheet and the income statement. In fact, the statement of cash flows contains no incremental information. You could prepare a statement of cash flows just using information you have from your income statement and from your balance sheet. I've already mentioned this, but the direct method statement of cash flows prepares cash flows from operations by subtracting cash disbursements of supplies, employees, and others from cash receipts from customers. The direct method is rarely used, but it is the suggested method. As previously mentioned, the indirect method calculates the operations section of the statement of cash flows by adjusting accrual basis net income to the cash basis. Rule A, adding back depreciation. Rule B, adding back losses. Rule C, subtracting out gains, and then making several other changes based on changes in current assets and current liabilities. The operating section is the only section of the statement of cash flows that differs between the indirect and the direct method statement of cash flows. I will be providing examples and answers to those examples for doing the statement of cash flows and looking at the income statement. Note that most firms present their cash flows using the indirect method. This is the end of section 3 and the end of the PowerPoints for the accounting workshop. I hope you enjoyed them.